G'day and welcome here. Thank you very much for joining us today. I'm Bryce Robertson, principal at PropertyWorkz, and today we're really excited to share with you our latest investment opportunity, Hazelwood Mobile Home Community in St. Louis, Missouri. So over about the next hour or so, we're going to share with you, we're going to be walking through our investment summary and covering some of the high level items through this investment summary. And at the end of this, we're also going to be digging into some question and answer. So make sure that you listen to this all the way through the end. And because the question and answer part is going to be pretty great for you guys. We are actually pre-recording this. Sometimes we do this live, sometimes we pre-record. As most of you know, we're a little bit on a time pressure crunch for this investment. We're buying this investment all cash. We don't have the financing period. So we're working very quickly towards closing here. So therefore, we're doing a pre-recording on this. However, in the question and answer, all of you, our investors out there, have been great enough to send us your questions. So we're going to be working off those in the question and answer. So it'll kind of be like you're here with us anyway. So again, this is going to last for around about an hour. We're going to dig into this in as much detail as we possibly can and hopefully cover everything that we can here for you. Now, most of you should have received a investment summary, which is literally what we're working off here. We're walking through this investment summary. You should have received an email. If you are a PropertyWorkz Inner Circle member, you would have received the new deal alert with this investment email. If you did not, then that means that you're not yet a PropertyWorkz Inner Circle member. That's okay. This particular investment happens to be a 506c offering. So, but regardless, if you are not a PropertyWorkz Inner Circle member, make sure to reach out to us. Our contact details are going to be at the end of the slides here, and you can reach out to us and begin that process. We have to have you come through our system to be involved in this. There is a qualification process. But nonetheless, we welcome you all and thank you for allowing us to give you the time to walk through this investment with you together. So let's just get the slides going. A couple of important notices and disclosures, guys. I'm not going to read out this whole disclaimer here, but from a high level, we're not attorneys, we're not CPAs, we're not financial advisors. It's up to you guys to do all your own due diligence and to make sure that you are getting your own representations from your own CPA, attorney, a legal advisor to make sure that they're accommodating to your particular needs and circumstances. So just wanted to disclose that one there. And also throughout this webinar, I am just going to move the little window box here where you see Nolan and myself, just so that you have the opportunity to read all the different sections there. It's one of the, I suppose, setbacks of Zoom here that sometimes we cover up some of those boxes. So you might see me do that. I'll only do it if I necessarily have to. Okay, so this is a value add investment opportunity. And here is some photos of some mobile homes that we have at the park. We've got at the top there, we've got a couple of pictures of some new homes that have been brought in by the current operator. The really cool thing about that is that we know that in this market, new homes work. They don't work in every market. Sometimes we have to go with the used home model because the tenants in that particular market may not qualify for new homes because it's a higher price point. But in this market, it works out well for us. So we're very excited about that. And we've got some pictures of some older homes down the bottom there. In the bottom middle, you'll see a picture of a single family home. It's actually currently vacant right now. One of the first things we're going to do once we take over is go in there and do a remodel. We're going to change the roof out and do a full remodel in there. And then we're going to get a rental price of over $1,000 a month to rent that one out. And we've already had great demand in our test ads. So we know that we've got a lot of people out there that are looking for that type of rental property. And then we've got another little photo at the side there that we capture on one of our streets in the community. Okay, table of contents, we'll skip over that. But this mobile home community is located in the St. Louis, Missouri MSA, which is the largest MSA in Missouri. So we're very excited. We think it has a great location. We're about 13 minutes from downtown or the city limits of St. Louis and about 20 minutes to downtown. So great location. So yeah, let's dig into the executive summary here. So we've identified an opportunity to acquire 100% ownership in Hazelwood mobile home community. This property is a 37 lot mobile home community, and it's located in northwest of St. Louis, Missouri. Again, it's about 13 minutes to the city borderline, about 20 minutes to downtown. And we're surrounded by Fortune 500 companies such as IBM and Boeing. And Nolan, I believe that they're literally like in our vicinity there, aren't they? IBM and Boeing.
Yeah, exactly. As we kind of work our way through the presentation, we'll actually pull up a park map and a kind of an aerial map, and I can point out exactly where they are because we're neighbors with them at this park.
Beautiful. Yeah. So we believe we've got a very prime location there. Yeah. 5 miles from St. Louis Lambert International Airport. And our business plan here with this community, it's about 50% occupied. And our projected business plan is to purchase this with all cash. It's an all cash purchase. There's no initial financing. That's why it's a quick close. And then we're going to complete the infill and renovations that the current ownership started. There's currently a couple of vacant mobile homes that we're going to get in there. We're going to remodel those and fill those with qualified tenants as soon as we possibly can. We also have the single family home that's sitting there vacant. We'll be doing the same with that. And then we also have about 10 vacant lots that we're going to be bringing a mixture of new and used homes in and filling those with qualified tenants as well. We also have an opportunity to bill back our utilities. I believe that we're currently recapturing somewhere in the vicinity of 50% on our water and sewer, and the park's also currently paying for trash as well. So by year 2, we're going to stabilize those so that we're fully billing all of those back. However, we've underwritten conservatively so that we're only recapturing 90%. But that definitely has a positive impact on our net operating income. And overall, we're going to be working to decrease our operating expenses, increasing our revenue, refinancing at about the year 2 to year 3 mark. And at that point, we will be returning, we're projecting to return investor capital. And then essentially, investors get to remain in the deal full cycle to gain the further upside as well. So essentially, investors can look at this and say, hey, once that refi event happens in year 2 or year 3, now we've projected and underwritten for that to happen in year 3, although we're planning in our operations to complete that in about year 2. We believe we can work faster than what we've underwritten here. We want to remain conservative. And at that point, investors are essentially involved in the deal risk-free because the original capital invested gets returned. But you guys get to still remain in this deal, and investors can gain on the cash flow on the upside. I will disclose that there is a qualification process here. This is not an offering. There is more steps to take after this. We'll talk about that later on. And then, yeah, we're already buying this from an operator who, as I previously said, has brought in 4 brand new homes, has proved that the cash program works. I'm not going to dig into detail on what the cash program is yet. We're going to dig into that, into the question and answer at the end of this presentation. But there's an amazing program that 21st Mortgage has where they team up with local mobile home manufacturers, and essentially park owners can get new mobile homes into the community for a very, very, very small price. And essentially, by the time we're done with it, we could almost be in it for nothing. So I'll talk about that and exactly how that works in the question and answer section at the end here. And we have an expected 7-year hold. We believe we're in a great location here. We're excited to stabilize the occupancy. We believe that we can increase the occupancy very quickly. And we're excited to increase revenue and also reduce the operating expenses and capitalize off the growth in the largest MSA in Missouri. So a little bit of stats here on our offering summary. We're going in at a purchase cap rate of 6.2%. Now we're seeing cap rates in the range of about 5 to 7% right now. So we're not doing too bad on the purchase cap there. But the cool thing is that once we've built back our utilities and done a few things in the first couple of years of operations, we're going to be double digit on our cap rate based off purchase. So we're really going to get to increase that cap rate based off purchase when we're going through our business plan. And we've conservatively underwritten to have an exit cap rate at 8%. We always like to add on much more to our exit cap. We like to be very conservative there, just in case there's some volatility in the market. And we believe that an 8% exit cap is very conservative. Again, right now we're seeing cap rates in the 5 to 7% range, and we feel very confident that we would be able to work with is something in the 6 to 7 range. But nonetheless, we've also got an exit cap rate, and we've also got our refinancing cap rate at 8% because we really wanted to have a little wiggle room there for any market volatility. We're going in with an expense ratio of 58%. Now, that is a little high, but also we're at 50% occupancy. There's only about 17 occupied lots so far. So that expense ratio massively decreases as we're increasing our occupancy. And yeah, as you can see below there, our occupancy is about 47% straight out of the gate. And our purchase price is $525,000. That's $525,000, all cash purchase, no financing out of the gate. But we are looking to refinance once we've stabilized the occupancy. So once we get to 70 to 80% occupied, then we have the option to be able to refinance there, at which point we are projecting to return investor capital and then keep our investors in the deal for 7 years. That's the whole period there. And so we have an accumulated equity required of $906,688. So that's a total of our purchase price. It's also our capital expenditures and our closing costs as well. And it also, it's taking all of those things into consideration. So a little bit more information here. We're anticipating that our limited partners would receive an 8% preferred return. And then beyond that 8% preferred return, investors would receive 100% of remaining cash flow thereafter up until the refinance event, which we're projecting would be at the end of year 3. And we're planning to have that be the end of year 2. But nonetheless, this essentially means that our limited partners, our investors, will be getting paid first before us. They'll be getting their 8% preferred return. That's what we've projected there. And then 100% of remaining cash flow after that goes to investors. So literally, all of the cash flow is going to investors until that refi event. So that's very good motivation for us to perform on what we're projecting here. And we believe that investors should get paid first, and we believe that we should be performance-based. We're very confident in our skills to execute our business plan. So we feel really great about that, and we hope that you guys do too. Then at the refinance event, we are projecting to return the original capital invested. Now, for example, the minimum investment in this particular offering is a $50,000. So if an investor invests $50,000, we're projecting for them to make 8% preferred return on that. Then 100% of remaining cash flow goes to investors after that. And then at the refi event, that $50,000 is projected to being returned to investors. And then literally basically can feel very comfortable being in the investment after that, essentially risk-free, because the original investment has been returned, and then investors get to enjoy the upside until the end of the business cycle. So we do change our equity structure and cash flow structure slightly after the refi event, as I'm sure you can appreciate that we put our best foot forward to make sure that we're paying our investors first. Afterwards, that we've obviously proven ourselves. And so we have a 50-50 split on cash flow and equity that happens after the refinance event, where limited partners get to participate in 50% of the cash flow and 50% of the additional equity at the sale event as well. And again, the minimum investment on this one is $50,000. And we anticipate quarterly distributions and reporting. So just going to touch on that real quickly. Typically, the way we work is that once we close, we take over, and then we have the first full quarter of operations. After we've had the first full quarter of operations, about 30 days after that, we typically send out our distributions and our financial reporting where investors will receive a P&L and also a written report which recaps the last quarter, what happened in operations, what challenges did we have, how do we overcome them, and then some projections on what we're planning to do in our business plan for the following quarter, so you guys can follow along. We believe that we're very transparent in our reporting. We tell you the good, the bad, and ugly. And of course, we always bring solutions to the table. We never bring a problem without multiple solutions. So the minimum investment on this one is $50,000. The purchase price of this community is $525,000, all cash. We're estimating the refi at year 3, although we're in operations in our business plan. We're anticipating to do that closer to the 2-year mark. And the hold time for this investment is 7 years. Again, total equity required, $906,688. And then moving over to the partnership structure, the first hurdle is for limited partners to get paid their preferred return of 8%. So that goes to investors first. And then the next people to be paid after that is, again, our investors who get 100% of remaining cash flow up until the refi event, at which point after the refi event, all of the cash flow and equity is split 50-50 between our limited partners, our investors, and our general partnership, which is us, who is driving the ship here. So I am going to introduce Nolan Freeland, who is our operations manager. He's going to walk you through this slide here of our projected returns and assumptions. Again, Nolan's our operations manager. He also is heavily involved in underwriting and acquisitions. So Nolan, I am going to pass the torch on to you so that you can walk us through some of these numbers here.
Excellent. Yeah, so we'll just dive right in here. Total equity that we're anticipating or that we're going to raise on this deal, as you can see and have heard a couple times already, is $906,688. And so obviously $525,000 of that goes to the purchase price. And then we also have about $381,688 left over to cover, closing costs, CapEx, all of that stuff that we'll kind of dive into in a few later slides. But that's the money that we're going to use, obviously, to turn the park into what it can be. As we move kind of right along here, we have our unlevered IRR, and our unlevered IRR is basically IRR when there's not a loan in place. And since we are purchasing this community cash to start with, that is kind of the IRR that we're going to look at here. And as you can see, that's a little over 19%. And then right below that, we have our total project IRR, and that takes into account our refinance and the whole project. So that's through year 1 to 7, that's the IRR for the whole projected period. And then we have the LP IRR, which the only reason that number is different is because it takes into account what's only investor capital, not what is GP or sponsor equity and capital. And as you can see, we're projecting an 9%, almost 10% cash on cash, which you can kind of see over there on the right side. That's where that number comes from. It's an average of the hold period. Annualized return, which is cash flow and equity, is just under 19%. And our equity multiple is over 2x, 2.3x that we're projecting. We can dive into that in a second. And then we dive into our sponsorship structure here. And because we are really try and push alignment of interest with our investors and incentivize, the GP to perform, and we have a 2% acquisition fee on purchase, and that really just helps us keep the lights on. And then we have a 2% asset management fee of gross income. And also, we don't have it listed here, but we also have a 5% property management fee for offsite management. And then, as Bryce mentioned a second ago, we got the 8% preferred return, which is, our minimum return is 8%. And as we dive over here to year 1, this is an example of a $50,000 investment. Year 1 is, under 8%. So that number is going to be accrued, and what isn't paid and the 8% is going to be paid out, in year 2 or year 3 when that catches up. And as you can see there at the beginning of year 4, we have that refinance. So we're projecting to return all investor capital at that refinance event. And so you'll be in the deal, relatively free and clear and still getting cash flow of pretty awesome returns of, double digits.
Yeah, thanks a lot, Nolan. Thanks a lot. Appreciate that. And just going back on the sponsorship structure here, we did mention, Nolan mentioned that we've got an acquisition fee. That's pretty much just to take care of all of the things for us putting the deal together, getting the loan, all of the stuff that we have to do up front. That's a 2% of purchase price that we actually get at closing. And then the asset management fee, that is of gross income. So is property management fee. Really, that just keeps the lights on. We're not looking to gouge our investors with fees. We're actually pretty low on fees. We don't have many different fees in here. We would rather go with the performance-based model. Really, those fees just cover us to keep our baseline expenses for our property management, our asset management, some of our staffing. And again, it really just keeps the lights on. It's not any kind of huge benefit for us. Where we get paid as operators is in the cash flow beyond the refi, and then also at the equity at the end of the investment cycle, where we get to cash in on the sale there and our portion of the equity. So really, we get paid mostly at the end. So it's up to us to perform all the way through this investment, because the more money we make for our investors, the more money we make for us. We love that setup. We love it for you. We love it for us. It keeps everybody in check. And we hope you guys appreciate that as well. We know that there's some other operators out there that like to add all these different fees, and we're just not interested in that. We'd like to keep our fees to the minimum, only have what's essential in there so that we can make more money for you guys. And then essentially we end up making more money for ourselves anyway. And just at the bottom here, you will see that the accumulated, if you were to invest $50,000, then it's projected here that at the total of 7 year, you would be getting a 68.57% return on investment. And that would translate into $34,285 of cash flow out of the $50,000. And then you can also see at we've projected to do the refi at the end of year 3, but then that worked through to the beginning of year 4 here in our numbers, where you see that we've projected $53,492 to be returned to the investor. So that's a little bit more than the original capital invested. And then investors are essentially in the deal risk-free after that and still gaining double-digit cash flow, which we hope that you find very attractive. And we certainly feel confident about that, and we feel happy about that. And then at the end of year 7, we get to tap into another slice of equity there for you guys. And so that's the overall projections there. Okay, so let's dig into some of the highlights of our business plan. Our business plan here is to renovate the vacant homes. It's to bring in new and used homes on the vacant lots. We're actually planning to bring in 10 homes on the vacant lots, 7 of which would be new cash program homes, which we'll talk about a little bit in a minute here. And then 3 would be used homes. And then we're looking to implement our utility recapture program by billing back the water and sewer and trash. That is expected to be fully implemented and stabilized by year 2 of operations. And then we're always working to increase revenue and decrease expenses, which drives up the NOI over the hold period, which ultimately is what we're looking to do, because that gives us the highest sales price at the end of this investment cycle. So to start off with, we've got 9 vacant park-owned homes, and they're in various conditions. So we've underwritten here to renovate 6 homes in year 1, and then 3 homes in year 2. And we're going to do that for an average of about $6,600 per home. I'm just going to move this down here so that you guys can see that there. We also anticipate renovating and renting the single family home within the first 2 years. Well, those have been our projections in our underwriting. In all honesty, we're planning to do all of the renovations on those 9 park-owned homes in year 1. We're certainly going to do as many of them as we can. We believe that 6 is a very conservative number. We're also planning to fully remodel the single-family home in year 1 as well, and have it rented in year 1. But we wanted to be conservative on our timing. We didn't want to be too aggressive with our projections, so we underwrote it conservatively. But just please keep in mind that our actual business plan is significantly more aggressive than what we've underwritten here. Also, on our on mobile homes, market lot rents. This is for lot rents, for paying for the space rent for tenant-owned homes, is currently $350 to $435. Now, we're currently at 336, so we're already below market rents. But we didn't underwrite for a rent raise until year 3. And we did this specifically. We didn't want to be, we know that there's some market volatility right now. We didn't want to be too aggressive with our projections. We do believe that we could raise rents straight out of the gate, although we didn't want to underwrite like that. But the good news is we've got plenty of upside there. We know that straight out of the gate, we can raise our rents. We are an attractive park in this area. We do have a quality asset here. And so we're going to be able to tap into those lot rents. And then also on our park-owned home rents, the market is 380 to 487. Now, Nolan, refresh my memory. I think our park-owned home rents currently is in the 200 range, I believe. I think it's in the high 200s.
It is.
So
Yeah, we're definitely below market on our home rents as well. I believe it's around 262 average.
yeah. And we've got that specific number coming up in another slide here soon, but we're significantly under on our park-owned home rents. And the cool thing is that we know that we can rent for $450 on just the home rent in our markets, because we have a home in our community that is renting for $450 a month. It's one of the new homes that got brought in. We also know that we can use the cash program in our community. So we feel really good about being under market. And then our single family home is currently not rented. It's currently vacant. It needs a mild remodel. We're going to do a full remodel, and we're going to do change the roof as well. And then after that, we've underwritten so that we have our single family home rents at $875. However, market rents are currently $875 to $1,300 a month, and we believe that we could rent that for at least $1,000 straight out of the gate. So we're feeling very good about our market rents, and also for the demand there for single family home rentals. And so we feel really good there. Then as far as the lot infill goes, we currently have 10 vacant lots. We plan to bring in 3 used homes and 7 new homes. Now, current ownership has brought in 4 brand new homes into the community, 3 of which are currently on rent credit programs, one of which is with the cash program. So we know that rent credit programs at that price point work in this community because we've got evidence that they do. Our market research told us this, plus we can actually physically see it in the park in the current operations, and cash program works in there as well. So we feel really good about that. A little bit on the numbers of our used homes and new homes. Now, the used homes, we've underwritten for each used home to be purchased, transported, brought to the park, set up, hooked up with utilities, skirting, steps, and then passed on to the tenant. And we can do that typically $15,000. Our track record has been $15,000. However, we underwrote this for $20,000. Add a little bit of extra wiggle room in there. And then our 7 new homes, and I'll explain that in much greater detail. We're going to use the cash program on that. Basically, the long and the short is each home would cost us temporarily $6,000 because we're responsible for setting up the skirting and hooking up the utilities and getting the steps and stairs and everything hooked up as well. That'll typically cost us around about $6,000. But then we get reimbursed that $6,000 once we find a qualified tenant that signs a mortgage signs a loan with 21st Mortgage. But I'll break down exactly how that cash program works in detail in our question and answer at the end of this presentation. And so even though those 7 new homes only cost $6,000 temporarily, we have underwritten for the cost of $20,000 for each of those homes, just to give us complete wiggle room. If we ended up bringing in all used homes, we just didn't want to leave anything out there that could possibly go wrong in this deal. So we wanted to make sure that we're absolutely calculating and being double and triple conservative on everything. So we believe we've got tons and tons of wiggle room there. And yeah, as mentioned, a tenant just brought a new home in our community and are paying $450 on park-owned home rent, and the cash program is working well in our community as well. And so as far as the operational improvement here, We like, for this size park, we like to use a model where our maintenance guy doubles as our on-site manager. And we like to lead with our maintenance strength because they can help out with repairs and maintenance. And it's much easier to train people on the management side of things than what it would to be if we got a manager and trained them on the maintenance side. But the cool thing is this park already has a manager in place. He's already a manager and maintenance guy. He's been there for about 20 years and he's been doing a great job. The park looks great. So there's no problems there. We haven't seen any problems. Again, he's been living there for about 20 years and he's been managing the park for about 4 years. And so that's great. So we've already got someone in place there. So we feel really good there. And we're very excited to be working together. And then also, again, we've mentioned this previously, the current ownership has individually submetered all the units for recapturing water. So the meters are in place, but they haven't actually fully billed back. So we don't even have a CapEx cost in relation to that because the meters are already in place. We can just straight up start implementing a recapture program for sewer, water, sewer, and trash over the first 2 years. And by the end of the second year, we'll be fully stabilized on our utility recapture, which we're going to aim to recapture 100%, although we've only underwritten for us to recapture 90%, just to remain conservative there. And then to continue our business plan here, again, we're anticipating a refinance before the end of year 3. You'll see in our underwriting that even though we're projected to do the refinance at the end of year 3, the actual refinance payout has been projected for the first month of year 4. So that's why you will actually see that in year 4 of our projections in some of the assumptions that we have in here in our underwriting. And the exit strategy is we anticipate holding this for about 7 years. Now, we mentioned this before, cap rates currently, they're 5 to 7%. That's what we're seeing out there right now. We feel confident that we could refinance or we could sell this park as low as a 6 cap. And we feel we could even do it as low as a 5 cap. We don't want to claim that though. There's a possibility that could happen. And we feel very strong that we would be able to at least trade this and refinance this in the 7% cap range. But having that said, we want to remain conservative in our underwriting. So for our refinance cap and for our exit cap, we've got that at 8%. So we believe we've got tons of wiggle room there. If something happened, God forbid, and interest rates go up and cap rates go up with it, we believe that we've got solid wiggle room there. And then just wanted to just detail some of our underwriting. We've talked about having conservative underwriting. We've talked about some of these points. I just want to dig deeper on some of these points here so you can understand that we're not trying to project to you the craziest, most aggressive plan. We're actually presenting what we believe is a very conservative plan. And here's some of the reasons why. So we underwrote with overall expenses beginning at 63% at purchase that trend down to about 35% at year 7. Now, in actual operations, we're anticipating expenses to be closer to 55. We can keep our operational expenses down, knowing that we are the operators and we know what our expenses are. And then as the occupancy increases, that will trend down to about 35%, we believe, at about year 4 onwards. But having that said, all of the numbers and everything is projected off us, not trending down to 35% until year 7. However, we believe we could do that at about year 4. Another item here is we gave 20% expense ratio to our park-owned homes and single-family home income. Now, what do I mean there? So above, we talked about the expense ratios on the lot rent. Well, we put an additional expense ratio on park-owned homes. So anybody that's paying home rent to the park, we've calculated that 20% of that revenue that comes in for those park-owned homes and for the single-family home is going to go towards being able to cover repairs and maintenance. Now, the interesting thing about that is that we're going straight in and we're remodeling the single-family home straight out of the gate, so there shouldn't be any repairs and maintenance. And in addition to that, we're also remodeling all of the park-owned homes that are sitting there as well. However, We have underwritten that every single one of the park-owned homes through the life cycle of this investment, which I believe there's 18 of them all up that we've projected in the life cycle of this investment, we've projected that there would be at least one turnover for that particular park-owned home. So that means we remodel the home, find a qualified tenant, they come in, they're renting it off us, and then 1 or 2 years later down the path, for some reason or other, they don't want to continue renting that home, they move on somewhere else. Temporarily, the home is vacant. We've baked in a $3,000 remodel cost for that intermediate period until we find another tenant. And then we find another tenant and fill it up. Now, the interesting thing is that we did that for 100% of our park-owned homes. We applied that $3,000 capital expenditure item to just make sure that we're totally covering everything. But in actual fact, we have a 5% turnover rate in the mobile home park space, as opposed to about 40% in the multifamily space. Most people that come into mobile home parks are staying there and they're not going anywhere. So we have really low turnover in the mobile home park space. However, we still wanted to calculate that 100% of the park-owned homes turned over once, and we had a $3,000 remodel cost in there. So we believe that that's conservative. But then when you add the additional 20% of operating expenses off revenue for the park-owned home and single-family home income as well, we believe we've been double conservative. So we think we've got tons of wiggle room and that we would be able to handle anything that comes up there. We also underwrote with, let me just move this box up here so you guys can see. Yeah, we also underwrote with 6 vacant park-owned home remodels, 1 single-family home remodel year 1, then 3 vacant park-owned home remodels and 4 new home purchases in year 2, then 3 used home purchases and remodels in year 3. Having that said, as mentioned before, and I think I've mentioned it a couple of times, we're expecting to knock all of that out in the first 18 to 24 months. So we've underwritten for that to happen in 3 years. We believe that we'll do that in half the time, if not 2 years, but we still wanted to have wiggle room in there just in case anything popped up. We didn't want to over project things. So we really do feel like we've got lots of wiggle room there and that we'll crush it much sooner. We also underwrote with a refinance at the end of year 3, but we can refinance as soon as we have a stabilized occupancy, which is 70 to 80%. So we believe that we could do that as early as year 2. We could even do it a little bit sooner there, but I wouldn't want to overstate that one. So we believe this gives us great flexibility to move with the markets on the timing of our refi. We're certainly watching interest rates, and we're going to talk about that a little bit more in the question and answer section. And we also underwrote with a 5% annual increase in property taxes to hedge against potential property tax increases in the coming years. That is one of the things that we believe is a little out of our control, and we definitely wanted to take that into consideration, and we definitely didn't want to exclude that possibility in our underwriting assumptions. We also underwrote with a no park-owned home rent raises, period. And then we held off on our lot rent increases until year 3 in our underwriting. Whereas we believe anybody coming in that's signing up for a new park-owned home, we're going to be significantly above our average park-owned home rent. So essentially, we do believe in our management plan that we will be able to raise lot rents and park-owned home rents and single-family home rents as well. But we wanted to remain conservative, so we underwrote with no park-owned home rent, no single-family home rent increase, and also that lot rent increase is only at year 3, although we could probably do that straight out of the gate. And in fact, we may just do that. So we also underwrote with $200,000 as CapEx for the 10 new homes. I mentioned that before. In all honesty, that's probably going to cost us about $60,000, but we wanted to have that extra capital in there. We would rather take that risk on returning more capital to investors than to cut ourselves short there. So we truly hope that you look at all of these individual conservative underwriting assumptions and combine them collectively and feel as confident as we do about this, that this really is, we are really giving conservative projections here. It's always our highest intention to present something to our investors and then to, in actual operations, not only to meet, but to exceed what we've projected. We believe that's the best way to keep all of you engaged and to keep all of you impressed. And that's certainly what we're working towards with this investment. Although we definitely wanted to have all of the wiggle room in there for anything to happen throughout the business plan. A little bit on our vacant homes, a little bit more of a cost here. These are some photos of some of the vacant homes that we have. We've currently got 9 vacant park-owned homes and 1 single-family home that's vacant. And we've budgeted 5 of the park-owned home remodels at $8,000 and 4 of the park-owned home remodels at $5,000, and then a $25,000 remodel for the single-family home, some of which is going to go to replacing the roof. We're going to put a new roof on there as well. And then we've got some vacant lots here. These are the home sizes. So I mentioned before, these are actual images of some of our vacant lots. The cool thing is that we've got developed lots. We've got utilities going there. The city has approved our home sizes. We're good on setbacks. We've actually got really, really small setbacks at this community. In fact, on the actual property lines up against other properties, we can be literally, our setback is 0. So we've got amazing setbacks in this community. So we've got tons of room to really maximize the largest size homes. We always want to put the largest size home that we can possibly put on any lot. And so that's worked out for us that we can have 2 14-foot by 32-foot homes. This is the brand new homes that we're going to use the cash program on. 1 14-foot by 40 home and 4 14-foot by 50-foot homes. And then also for the 3 used homes, we are anticipating to have 2 at 14-foot by 60-foot and 1 of them at 18-foot by 70-foot. Now, we also may pass on going those 3 used homes, and we may actually go all 10 brand new homes, but we wanted to just underwrite conservatively and have that in there. So if we go that and we end up going with all cash program homes, then we'll be further reducing our costs and further increasing the curb appeal of this community, because we're going to be having more new homes. And we've mentioned this a couple of times. We're going to do a utility bill back recapture. This is one of the most fantastic ways to crank up the NOI. We get to increase our revenue while reducing our expenses at the same time. Currently, the current ownership is billing back 42%. So correction on that. I think I said 50% before on water consumption. And we anticipate implementing 100% of trash bill back in the first year of operations. And by the end of year 2, we're anticipating having implemented 90% utility recapture on water and sewer consumption. So it doesn't cost us anything. It's a great way to increase the NOI and also for us to increase cash flow as well. So we love that. Great component to this value add deal. And then here we've got our CapEx budget. So I've already spoken about some of these items here. Here's a bit of a breakdown. Our park-owned home remodels and turnover. That $103,000 is actually a combination of 2 things. The first thing is the $3,000 that we've calculated for each of the park-owned homes to turn over once through the business plan cycle. And we've also got in there the park-owned home remodel costs that it's going to cost us to remodel the current vacant park-owned homes. Then we also have the single family home remodel, $25,000. That's a remodel on the inside and take care of anything we need to outside, including the roof. And then here's our conservative lot infill. So we projected $200,000, or we calculated for $200,000 here. We could do this for, if we go all 10 cash program homes, which would be new homes, we would end up forking out about $60,000, not $200,000. And that $60,000 would get reimbursed to us once we find qualified tenants that sign up on the loans there. So we just really feel comfortable about having tons of wiggle room in our capital expenditures. And again, we would rather over project on how much capital expenditures we need and then provide higher, having to return more capital to our investors than understate that and catch ourselves with our pants down. And we really feel like we've got a lot of wiggle room here. We've also carved out $5,000 for landscaping. It's not a big park. It already has good curb appeal, but there's a few things that we believe that we can do that's just going to pretty it up and make it even more sexy as people are driving past and to attract more people. And we've also got $8,000 of road repairs in there. We've got paved roads in there. They're in great condition. We just have $8,000 of CapEx in there for some minor repairs and patching there. So that comes up to a total of $341,000 on capital expenditures. Then the debt summary here. So again, we're purchasing this all cash, and then we're anticipating at the end of year 3, we are going to be refinancing the property, and we have underwritten with a conservative refinance cap rate of 8%. Also, we've got some other assumptions here with our debt financing. The principal balance is $960,000. We anticipate having a loaned purchase price, LTV, of 64%. Now, the reason why that's a number there, 64%, is because really all we're projecting to do is to return investors' capital, so investors can get their original investment back and then be essentially in the deal risk-free after that. So that's great. We feel like we've got tons of wiggle room with our loan to purchase price there as well, especially when we're taking into consideration our cap rate. We've underwritten with an interest rate at 4.5%, fixed with an amortization period of 25 years. Now, back on the interest rate, we could get as low as the 3% range, if not low 4s. So we believe that that's a pretty conservative number. But again, we really feel like we've got tons of wiggle room in our loan to purchase price, and we're being conservative with an 8% cap rate here. So ultimately, we are planning to have that loan to purchase price be even lower. And loan term 5 to 7 years. So we wanted to have a little bit of wiggle room in there. We're anticipating, we project to have a 7-year exit on this, but we always like to have a little bit of extra wiggle room with our financing, just in case there's market volatility at the time and we had to wait a little, or in case we got something a little bit early there too. We like to have some wiggle room there with our financing. And then the property overview, again, this is located in Hazelwood, Missouri. So that's actually the city name, Hazelwood in Missouri. It's about 13 minutes north of the city outskirts of St. Louis. And this community is comprised of 36 mobile homes, 11 of which are resident-owned homes, 15 are community-owned homes, 9 are currently vacant, 6 are rent credit program. We're going to talk more about the rent credit program in our question and answer here at the end, which we're coming up on soon. And then there's currently 10 vacant sites and 1 single family residence. There's also a slight possibility, we didn't want to work this into the business plan, but there's a slight possibility that we may be able to fit a tiny home or a small structure on an additional lot that we've not even mentioned here. That'd just be cream on top, and certainly something that we're going to work towards, but we didn't want to underwrite with that. And the current average monthly site rent across all of the 17 occupied sites is $336. And I think our lowest other market average is $350. So we're looking good under market rents there. And Nolan, again, I'm going to pass the torch over to you so you can walk us through some of these numbers here.
Yeah, exactly. So again, 525,000 purchase price. This is a 36 space community with 1 single family home. And Bryce kind of just went over the unit mix, which I'll touch on briefly down here as we kind of talk about the average rents and the market rents. So pretty low risk park with electric is individually metered and directly billed to the tenants from the power company. Water and sewer is public water and sewer, and that is partially billed back, which we plan to implement a full bill back. And then we have the trash, which we also plan to pass along that expense to the tenants as well. And as Bryce already mentioned, we did underwrite to 90% recapture on the utilities here, whereas in reality we are anticipating to get 100%. So
Pushes
moving
close to
on.
100%.
Yeah, exactly. The single family home that we have here, it's currently vacant, needs to be renovated, but we are projecting to rent that for somewhere around the $1,000 range. As you can see here, the market for this area, the submarket here, Hazelwood, averages from about $875 to $1,300. And again, we're kind of hoping to land around 1,000. And then we do have 11 tenant-owned homes in the community who are paying an average lot rent of $336. Really, the average market rent for the St. Louis area is about $365, $370. A couple comps were around $350. And so we actually don't underwrite or anticipate to raise rents until year 3 on lot rents. And so, we're coming in straight away. There's upside in lot rents, and there will continue to be so throughout our ownership of this property. The community also has 5 rent-to-own homes, tenants who are on the 21st mortgage program already. And they're paying $315 a month currently. And then the market supports, comps all the way up to $487 a month for home payments, which just proves it's a great market for tenant-owned homes. Not all markets work with tenant-owned homes, but this one certainly does. Again, right here, the park has currently one rented park-owned home, and that home is renting for $350 above lot rent. And again, kind of push that number, a max of $487. And we don't, in our underwriting, we didn't have any park-owned home rent increases in our projections. So there's definitely upside there should we choose to realize it. And then we have the vacant park-owned homes here. We have 9 of those. And again, we're going to rent those out at market, and our vacant lots will be the same story.
Yeah. Thanks, Nolan. And you can see at the bottom there, once we're totally occupied, you look at the current average rent and what the market possibilities are. I mean, there's a lot of upside here. There's a lot of wiggle room. We feel really good about that. We feel really strong about this. And then one of the things, I'm not sure if we mentioned this yet, but whenever we purchase a mobile home park, part of our due diligence is to make sure that we've got enough demand to actually be able to handle these infill projects. And so we wanted to see in this market that if we ran a test ad at the price that we're expecting to be able to rent these homes at, that over a 10-day period of advertising, and we do that over 2 weekends and then the week in between, if we get a response rate that is 30 people or more to our test ads, then we can feel confident that we can fulfill our business plan, and then we're going to be able to have enough tenant demand to be able to fill the vacancies, to increase the occupancy. Cool thing is, we ran our test ads. Within the first few days, we ended up having about 160 responses, most of which were through advertising methods, which were free. I think there was just one of the advertising methods, which was Zillow, which was a very low cost item. I think it's like $10 a week or something like that. So it's going to be relatively cost effective for us to market for these mobile homes and single family home. And we had an astonishing response. There is so much demand for affordable housing in America right now. There's so much demand for affordable housing. Look, this is one of the reasons why we really, really feel confident about mobile home park space, is because depending on where you get your information, there's a need for about 20 to 30% of Americans have a need for affordable housing, which is to rent a housing cost of under $700 a month. There's only 44,000 mobile home parks nationwide. And while these recessions happen and economic downturns happen, everything compresses and pushes down to everybody downscales. Well, not everybody, but the people that do downsize, they're moving down in their accommodation type and cost, and that compresses down to mobile home parks. So right now we're seeing at our mobile home parks, I think the shortest waiting list we've got is 13 people of pre-qualified tenants who have already been through our screening. And that's like, we literally can't keep up with the demand. So we think that we've we've got a very good problem in our favor to be able to help the people in America fulfill this affordable housing need. I mean, mobile home parks can't do it alone. There's just not enough mobile home parks nationwide, but we're the largest contributor to being able to do it. And we got solid response from our test ads in this market. So we really feel good, not only about our price point, but there's a massive high demand for affordable housing in this area. And then here is a bird's eye view of the park, where you can see the lot makeout there. And then financial analysis. This is quite a monster underwriting performer here. And if we walked through all of the numbers here, one, we'd probably put you to sleep, and two, it'd probably take about 2 hours. So this is all provided in your investment summary. We're literally walking through the investment summary as we speak. So make sure that you guys look through that. If there's any particular questions that you have, make sure to reach out to us. We can certainly answer those for you. We want you to make sure that you fully wrap your head around everything here. But this is our underwriting pro forma with all of our projections here. So you can see a detailed report of that. And this is page 21 of your investment summary here. This projected returns and assumptions, we saw this earlier in these slides, so no need to go it over twice. We just wanted to keep it together at the end here with the projected assumptions and pro formas. And now we move on to the market overview. I suppose the real long of the short here with the market overview is that, one, we're in the largest MSA in Missouri. So we feel really good about that for two reasons. One, high market demand for affordable housing, a lot of need for people to be living in affordable housing communities. And like I said, our test ads were off the hook. It was like over 160 responses. We feel really good about that. The second thing is that this is a decent market. It's a large market. It's the largest MSA in Missouri. And so we get a lot of contractors to choose from. And this is not a massive park. This is not any kind of insane business plan. We've certainly infilled significantly larger projects than this. And we just know that we've got tons of contractors to pull from here. We've got a lot of variety to work with all of our remodels. We feel really good about getting multiple crews in there and knocking out and working on rehabs. And if for any reason one of the contracts is busy because they're working on other projects, we've got so many others to choose from. We can't say that about all markets. It can be a little bit of a challenge from a property management perspective when we're in a smaller market. So we feel really good about that from an operational perspective, and also to increase the occupancy to fulfill our business plan. A lot of large employers here. There's a great population here, strong workforce, great area, solid education. We're feeling really solid about this market. And if you guys want to read a little bit more of the details here, you can check that out on page 24 of our investment summary.
Yeah, and I just want to touch and say that when we say large MSA, I mean, it's like around 3 million people. So there's, it is a really strong, big market.
Yeah, so 3 million people, and we need to fill about 17 or 18 spaces. So we're not taking too much of the market share there. We feel really good, and we don't need that many contractors to be able to help us out fulfill this business plan. And we've already figured out who most of our contractors are on this, and we've got backups and other backups, because that's the way we like to work. So feeling really good about this market. And then here's a little bit of stats on our demographics. You can see in that picture there on the left, the star is Hazelwood Mobile Home Community. And then you can see some statistics in the 5-mile radius, the 10-mile radius, and the 20-mile radius. A little bit of additional information for you there as well. Retail map here, again, stars in the middle, and then you can see some of the retail stores that are located in the near vicinity. Great location, tons of stuff going on here, but surprisingly, very quiet park, isn't it, Nolan? We spent about a week up there through our due diligence process, and I mean, you could hear the birds singing, and it's a very quiet, nice little spot that the park's located in, with a lot of cool things surrounding it within a very short distance. And as you can see there at the bottom bottom of the map. We're very close to St. Louis Lambert International Airport, which is very convenient for us to be able to come in and check in and for us to check up on things. So we feel good about that there. Great location. And then here's some case studies. So I'm going to go ahead and I'm going to move this little video box down here so I'm not blocking any of the wording here. So I'll try and put that over here for a second. Actually, let me put it here. So a couple of case studies here of some previous mobile home parks. So this is Sierra Sands Mobile Home Community we purchased in California. Purchased it back in 2015, 38 space park. So it's very similar size park as Hazelwood. 3-bed single family home with an office, laundry, storage building. So almost a similar setup. Started off as a 2-star community. This investment was open to accredited and non-accredited investors. We purchased it for $570,000, which was a very attractive 12% purchase cap rate back in 2017, and very impressive for California. We're very excited. Sorry, 2015. And then we ended up getting a private loan, 9% interest only. The trash was paid by the park, and then we projected to have an annual return for our investors of 25%, and that is cash flow and equity. So that was our purchase metrics and our projections back then. Let me just move this video box over. Then our business strategy was to raise rents to market, to fill all vacant homes, to convert all home renters to home ownership program. And I'm going to talk about our home ownership programs in the question and answer section. We also planned to increase curb appeal and increase the star rating, install gas and electric meters, bill back all utilities to residents, to develop the vacant lots. There was, I believe, 6 vacant lots in this community, to repave the roads, and it was a projected 5-year hold. Well, what happened is in 4.3 years, we ended up raising the rents from 280 to 355, which made it an 18.4 cap rate based off the purchase price. All vacant homes had been filled. We developed the 6 lots ready for new homes. We installed gas and electric meters at each lot. We built back the trash 100%. We repaved the roads fully. And then we increased the curb appeal from a 2-star out of 5 stars to a 2.75 star or a 2 3/4 star community. So we massively increased the curb appeal there, and we ended up selling it back in 2019 for $1.3 million. And we were able to return 57.14% annual returns to our investors, which was significantly above our projections. And I do want to definitely state that is this was a bit of a unicorn deal. We had a lot of things in our favor. Not only did we fulfill everything on the business plan, we also bought it when cap rates were still low, and we sold it when cap rates had compressed. That really, really helped us out on this one. So we knocked this one out of the park, and this one's a unicorn. We wouldn't say that this is a typical investment that PropertyWorkz brings to the table. Those investor returns were significantly above what we would generally anticipate, but nonetheless, a good example of a deal that we ended up knocking out of the park. It ended up working really well, and our investors were very happy on that one. Second case study, let me move this back down here again. This case study is for Marshfield, a mobile home community in Wisconsin, a 200-space mobile home community, a 3-star community open to accredited and non-accredited investors. We purchased that for a $3,000 purchase price, which at the time was an 8.7% cap rate. At the time, the market was in the 7% range. We ended up getting a CMBS loan. That's a commercial mortgage-backed security loan with 5-year balloon. And then there was a current 50% water and sewer recapture. And then we structured that with a 7% preferred return to our investors with a 70-30 split thereafter. And we projected an annual return to our investors of cash flow and equity of 22.2% and a projected IRR of 19.25%. The general business strategy for this property was under new management, under our vertically integrated property management company. fill vacant homes and prep and fill vacant lots, to convert all home renters to home ownership program, to enforce no pay, no stay rules, to increase rents gradually over 5 years from 261 to market, and 100% bill back of water and sewer, and a projected 5-year hold, then sell or refi. Now, since takeover, fast forward to today, interestingly, we have this literally under contract right now for $6 million. Since then, we had raised the rents from $261 to $320 a month, which is a 12.2 cap rate based off the purchase price. All delinquent tenants had been removed. We cleaned all of that out straight out of the gate. All the vacant homes and 11 vacant lots have been filled. 20 plus park-owned homes have been remodeled. Digital water meters have been installed to allow full water and sewer bill back. We improved the infrastructure of water and sewer lines and electrical pedestals as needed. We've had outstanding on-site management on this. We were a little bit rough out of the gate. We actually went through, I think, 3, maybe 4 managers on this one out of the gate. It was a bit rough there, but we ended up capturing our best manager and really outstanding management that we've got on site there. We've had on site there. And market cap rates have dropped to the 6 to 7% range. I believe that we originally underwrote with our exit cap at 9% on this one. And so, yeah, currently under contract for this one for $6 million, and we're looking really good on that one. We've got a solid buyer. We're feeling very great about this. So we thought that was another good example to bring to the table as well for a case study. Now, the management team. Now, if you guys are listening to this webinar, then you should be part of the PropertyWorkz Inner Circle. So you already know who we are. You already know me. I'm Bryce Robertson, the growth manager. I'm principal here at PropertyWorkz. If you don't know me, there's a little bit of information here. Originally broke into the mobile home park space back in 2015. Purchased my first mobile home park with a negative net worth, $2,000 in the bank, and unseasoned credits. We raised capital through family and friends to get that deal across the finish line. That was the example that we had there for the Sierra Sands mobile home community in the case studies. That first investment, once I got that across the finish line, I felt 10 foot tall. I also felt very, very compelled about the whole syndication model and bringing investors into our investments. So we stuck with that business model, and we've been using that one all the way through. So our mobile home park investments that we bring to the table, we open up to our investors. And this way we bring more deals to the table for you. It allows us to grow, which allows us to bring even more deals to the table for you as well. So yeah, co-author of the best-selling book, 10,000 Miles to the American Dream. I write articles for Bigger Pockets on mobile home park investing and also on macro economy. I've got mobile home park investing home study course, capital raising home study course. We do live events for both of those. Also do a mobile home park bus tour, field tour, where we take students to our park and show them the on-site operations and how things work. And I oversee all of the operations for all of our communities. And we do this through our vertically integrated property management, asset management companies, which we'll talk a little bit more about in a minute. I've got over 20 years experience in construction and construction management. So I love these value add deals. I love working on remodeling mobile homes and bringing in new homes. And I'm certainly not scared to work on the infrastructure. And we truly believe that these value add investments bring a lot to the table. And we feel really strong about it. We believe that that's where the most upside can be obtained. And we also believe that all of you deserve to be financially free. And we certainly do what we can to help you guys out along the way there. And that's another part of us being able to open up our investments to you, and also have a very strong presence on the educational side of things that, as you know, when you're part of the PropertyWorkz Inner Circle, you get free access to or discounted access to these educational resources, because we believe education is a very important part of investing as well. And then we've got Nolan Freeland, our operations manager. He's a real estate investor, operator, and property manager. and a resident of West North Carolina. He purchased his first mobile home park at the ripe age of 19, utilizing creative financing. Nolan has since gone on to complete over 100 real estate transactions, all closed with private funds. Nolan also self-manages over 12 multifamily investment properties. And in 2017, Nolan co-founded Asheville Real Estate News, a local podcast and real estate education resource for the residents of West North Carolina, which focuses on affordable housing, quarterly market updates, as well as general and local real estate topics. Asheville Real Estate News has featured guests such as Charles Dobbins, the multifamily attorney, John Heyer, the renowned real estate tax attorney, and even Asheville's very own mayor, Esther Mannenheimer. So Nolan manages the day-to-day operations for us through our vertically integrated property management and asset management companies. He's got excellent skills at underwriting and property management. And Nolan designed and created the ultimate mobile home park and self-storage financial model, which we use for our underwriting. And it's also used by mobile home park investors and self-storage investors nationwide. So that's a little bit about on us. And again, if you're part of PropertyWorkz Inner Circle, then you should already know this anyway. And if you don't, and this is the first time you're meeting us, then you make sure to follow this to the end slide where you get our contact information, reach out to us, and then we can begin the process of qualifying you and bringing you on board to our PropertyWorkz Inner Circle. So I am going to move this screen again here so we can fully see everything there. So here's the support team that we've got here going on here. We have vertically integrated, or you would call it our affiliate companies, property management and asset management companies. So Innovate Collective, the Innovate Collective team is driven by providing exceptional tenant and vendor experience while simultaneously innovating and obsessively increasing the bottom line for our property owners. That is our property management company. We truly believe that nobody can manage our properties as well as us. So we're very happy to be taking on the property management piece. Nobody is going to maximize the NOI and maximize these investments and give the customer service that we're going to give. So we feel very confident about having vertically integrated, and we feel like we have much more control over the outcome here, as opposed to outsourcing this to third parties. And we have the same setup with our asset management company, Cultivate Collective. And our Cultivate Collective team is return on investment centric, while simultaneously cultivating opportunities, investments, relationships, and systematization for our sustainable and collective prosperity. So again, we are vertically integrated on property management and asset management, so we can drive up the NOI, so we can increase the return on investment. We're in control of that, so we feel really good about that. And then again, we've got a couple of other of our support team here, our tax advisors and accounting, CFO consultants. Our legal premier law group takes care of our syndications and the SEC compliance. And then our transactional attorney is the MHP lawyer. Now, the cool thing about our tax advisor, and both of our legal advisors here is that they're all investors, and they all cater to investors, and they're currently actively invested in deals, and specifically on the mobile home park side. Our Mauricio, the head of Premier Law Group, he's actively involved in mobile home park investments. He knows exactly how they work. He knows the in and outs. That's kind of rare for syndication attorneys. They're not all involved on the active investment side. And same thing, I mean, hello, look at the title there, the mobile home park lawyer. Obviously, that's what he specializes in. He brings a lot of value to the table. We feel like we've got a really, really solid support team here, and we just wanted to share that with you guys. So now it's time that you've all been waiting for our frequently asked questions. We're going to dig into these. And then because this is pre-recorded, we've also got some other questions here that have come in from all of you, our investors, through email. And so we're going to work through those as well. So we're just about to wrap it up here, but we believe that this may even be the most valuable piece for you guys, because we get to answer some questions that may not have been touched on so far, or we can take a deep dive on topics that maybe you have some curiosities about. So our first question here is, when does my preferred return start to accrue? Well, it starts to accrue from day one of operations. So as soon as we close on this, the preferred return will start accruing then. Now, the next question is when should I expect my first distribution? Well, we anticipate quarterly distributions to begin 1 month after the first full quarter of operations. So for this particular investment, we're anticipating closing in late April, early May on this one. So then the first full quarter of operations would be Q3. So then at the end of the first month of Q4, that's the anticipated first quarterly distribution. And then we anticipate distributing quarterly thereafter, so every 3 months thereafter. And what we provide, I'm not sure if I've touched on this already, most of you know this, but what we provide when we provide our distributions is quarterly reporting. So we're going to have a quarterly report, which is going to be a written report, which will recap the operations that we've had over the last 3 months. And it'll also project what we are anticipating to implement over the next 3 months. And then there will be also our profit and loss as well, recapping the 3 months, and then a breakdown of investor distributions as well. Some accounting there for you guys. So that's typically what we send out in our distributions, and they typically happen 1 month after the end of each quarter. And the next question here is, can I invest through my self-directed IRA? Yes, most certainly we can accept qualified international investors and qualified international IRAs or their equivalents. And then the next question is, do I have to be an accredited investor to participate in this investment? The answer of that is yes. This particular investment is a 506c offering, which means that it's open to accredited investors only. And third-party verification is also required. So that means, so let me just talk about the accredited investor status. If some of you don't know what that is, there's 3 different ways that you can qualify that the SEC would deem you to be an accredited investor. Number 1 is based off net worth. If you have a net worth that is $1 million or more, not including the value of your primary residence, then you would be considered an accredited investor as far as the SEC goes. The second way to get involved would be, or to become an accredited investor, is off your tax returns, based off your income, your gross income on your tax returns. So we would look at your tax returns for the last 2 years. If you file singly and you file just as one person on your tax returns, then if you had $200,000 or more of gross income on your tax returns each year for the last 2 years, and you expect to have that in the following year, then you would qualify as accredited investor. That would work out well. And same if you filed jointly, you would have to have $300,000 if you file your taxes jointly with you and your spouse. You would have to have $300,000 of gross income each year for the last 2 years and expect to have that or more in the future as well. Then again, you would qualify as an accredited investor. So there's 3 different ways you can qualify as an accredited investor. And I'll add a little bit more onto that piece because this is a 506c offering. That means that third-party verification is required. So typically, investors will either have their CPA or financial advisor, and sometimes an attorney, provide documentation stating that they have reviewed your financials and that they do deem that you are an accredited investor. Now, you can do that personally, and you can go off to your own CPA, financial advisor, or you can also use some online applications. Verifyinvestor.com is one of them. You go on there. I can't remember how much it costs, but it's a relatively low cost that you pay, and then you submit your tax returns and answer some questions, and then they have CPAs on the back end that can review your information and give you that declaration that, yes, you are an accredited investor. We need that third-party report for investors on this particular investment because it's third-party verification is required. So wanted to point that out there. The next question here is, will the offering utilize debt financing? Well, once occupancy hits the 80% to 70% range, we anticipate refinancing, and the general partnership will obtain and sign for this financing. So yes, we will be getting debt. We anticipate getting debt, but straight out of the gate, we don't have debt. We're doing an all cash purchase for $525,000. And we are actually working up on some closing here pretty soon here. And I'll talk about the timelines and more in a minute. Another question here is, can I sell my shares before the offering is liquidated? Now, we get this question pretty frequently, which is why it's here in the frequently asked questions. But we suggest that if you're looking to invest in this investment or any investment with us, that you plan to be in the investment for the full investment cycle. Having that said, we understand life happens. Sometimes crazy things happen. And in those circumstances, the long of the short is yes, it is possible to sell shares to another investor, although there needs to be a qualified buyer to purchase those shares on the back end. And we can't in any way guarantee what the outcome is. And then typically from our experience, we have, it's typically $1,000 for investors to actually do that, because there's an administrational cost. There's quite a bit of paperwork and whatnot for us to do in our back office to make that happen. And we have a few lines of defense in there as well, where us, the GP, could have the first right of refusal, and then our other investors that are invested in the deal on the limited partner side, the LPs, they would have the second right of refusal. That way we can more effectively keep things in-house and do a quick exchange there. And if neither of those work, then we could also explore the possibility of finding a qualified buyer for those shares out there, or the investor would actually be responsible to find that person. We could help out the best we could. So it's a possibility, but I would certainly, if you're thinking that it's a high probability, I certainly wouldn't recommend getting involved in this investment or any other investment with us, because you should really be planning to be in this for the full life cycle and not anticipating on banking on guaranteeing that you'd be able to sell your shares, because again, it's not guaranteed that would be able to happen for you. Next, so also we've got some real estate terms and definitions here. You guys can read through that at your own leisure. I'm not going to bore you with that. What I am going to dig into now is that we have had the pleasure of getting some questions from some of you, our investors in the PropertyWorkz inner circle. And I'm going to work through some of these questions. I know that we're I don't know how we're going on time, Nolan, but I'm going to try and fit in as many as we can here. These questions have come in for you guys, so I'm just going to go for it. The first question here is, what is the cash program? So you've heard me talk about that, the 21st Mortgage Cash Program. Let me break that down in detail for you right now. How this works is that when we're looking to purchase a brand new home from a mobile home manufacturer, we can implement what's called the 21st Mortgage Cash Program. Here's how it works. We find the mobile home manufacturer. We will be looking for the manufacturer that has the homes that we want close to the area that we have the mobile home park. Then we select the home model and make that we want. We get all the purchase metrics in there. And then once we've made that selection, we bounce over to 21st Mortgage and we connect them with the home manufacturer and we say, hey, we want to buy this home. Okay. So then what happens is 21st Mortgage puts up, covers the cost for the home purchase and also covers the cost for the transportation from the facility where it gets manufactured to our mobile home community. At this point, we've got $0 in the deal, and we get a brand new home delivered into our community. And then we actually, at that point, start to incur some costs. We have about $6,000 in costs for us to be able to hook the home up to utilities, to set it down, to get it signed off by the local inspector, to have the stairs and the skirting and the decks and everything installed. That costs us about $6,000. So at that point, we have forked out $6,000, but we've got a brand new home sitting on our lot ready for someone to purchase. Then we go out there and we market and we advertise for a tenant to come into the mobile home. We put them through our qualification process. Once they pass our qualification process, we pass them on to 21st Mortgage, who they go through their qualification process. Once the potential tenant passes the qualification process, then they get to sign a loan with 21st Mortgage through the cash program, at which point the tenant is now responsible for 100% of the repairs and maintenance on that home. They pay the loan payment to 21st Mortgage. They pay the lot payment to us, the park owners, the operators, and then everybody's happy in the deal, and we get our $6,000 or whatever costs that we put up front there. We get that reimbursed just very shortly after the potential tenant signs on that loan. So at that point, we are in the deal for zero again. So there's an initial $6,000 upfront cost, then we are in the deal for zero. Okay, so you're thinking, all right, that sounds good, sounds great, but what happens if the tenant defaults on the loan? Okay, that's a great question, and this is what happens. At that point, essentially, we have two options, okay? So we jump in there and we start taking over the payments for the tenants. We can go through the eviction process, we can evict the tenant out of there. And then we can start marketing for a new tenant to replace them. We may have an interim remodel that would happen there. As mentioned before, we've calculated $3,000 for every single park-owned home. So we've already baked that in there. And then we would have the option at that point to find, we'd have 6 months to find a replacement tenant to be able to qualify for the 21st Mortgage Cash Program and sign on a new loan. That's great. It gives us 6 months. That's a really long time to be able to find a tenant. And especially in this market, we don't believe that we would even need to lean anywhere near on that timeline there. Now, if for any reason we didn't find a tenant in that 6 months, or we simply chose that we wanted to go an alternative route, then the park has the opportunity to be able to take on the financing. Then the park would own the home. The park would be paying the loan payment to 21st Mortgage. We'd go out there and find a qualified tenant, and then the tenant would be paying us a home rent, which is going to meet or exceed the payment that we have to pay to 21st Mortgage. We would prefer to not go with the latter, because if we do that option where the park actually rents the home, it becomes a park-owned home. The park's responsible for the repairs and maintenance, and we prefer not to do that. But it's a great additional option for us to have it in there as well. So that's pretty much how the cash program works. We're really excited about using that here at Hazelwood Mobile Home Community. So plenty of details on that there for you. Another question that came in from our investors is, why is the seller selling? Why did they leave upside in the deal? Well, that's a great question. Let me tackle the last part of that first. Most investors leave a little bit of upside in the deal. We also call it leaving some meat on the bone, because that opens us up to a little bit more of market capabilities to be able to have more buyers on the back end. So that's one reason. But what's actually happening with this community is the sellers, they are experienced mobile home park owner operators. They've done a good job of operating and managing the park so far. They have not fully implemented the business plan. They haven't owned it for a great deal of length, so they haven't had enough time to fully implement the business plan. And one of the reasons that they're selling, or the reason that they're selling, is because it's outside of their effective management footprint. So these operators, they have a handful of mobile home parks. They've got quite a few of them. And a lot of their mobile home parks are in a conglomerated area where they're close. So their regional manager can go from this park to that park to that park and check up on things in a cost-effective manner. This park and a few other parks on the outside of their effective management footprint. So just due to them as them individually and what their specific portfolio is, means that it's a little bit more ineffective for them to manage this park, because they have less boots on the ground in the area. They have less parks in the area, and it just comes down to them specifically owning parks in other markets. And so it's a little bit further outside of their management footprint. So it costs them a little bit more on the management side of things with the structure that they have set up for them particularly. So that's why that they're selling it. And also they bought this for an insanely low price, and it also makes sense for them to sell it at market right now. So that's kind of two reasons why they're doing it. And then this is a great question. I'm so glad that one of our investors asked this. Actually, we had a handful of investors that asked similar questions to this. What are the top 4 execution risks that you see? And I think that's a fantastic question and something that I'm really happy to touch on, because I'm sure all of you are thinking this right now. You're like, oh, okay, cool. You've told us about all the good things, but what are the top 4 execution risks that you see? Number one, one of the risks that we see is property taxes increasing. That's something that's out of our control. We don't control property taxes increasing, but with all the things that the Federal Reserve's doing and quantitative easing, they're going to have to get that money back somehow. It's going to be coming through the people. We anticipate that could be through inflation and through increases in taxes, property taxes being one of those taxes that could potentially increase. So a little bit of information on this property is that the way that this property is assessed, historically, we've actually seen property taxes trending currently downwards, historically and currently downwards in property taxes. However, we've baked in an annual increase to remain conservative. And I think we had a 5% annual increase here that we baked in here to hedge against property tax increases. So that's one of the risks. Another risk that we see here is eviction moratoriums. Again, out of our control. We don't get to control that. The thing about this is that, look, this is not just going to affect mobile home parks. This is affecting the entire rental sector for the most part. So, you know, these things that we're talking about here are literally going to be problems for all of us as operators, whether we're in the mobile home park space or other spaces in the real estate sector. So eviction moratorium. So luckily, we've been not impacted negatively by eviction moratoriums. We were able to get our evictions through before they kind of did the lockdown there. We've had some brief openings where we've been able to continue more evictions. And so we actually don't have, this particular park doesn't have any non-paying tenants or delinquencies. So we're looking really good here. Albeit this is a potential risk, and it's something that we don't see any risk in the immediate foreseeable future. Believe that the CDC has plans to remove eviction moratoriums in America here. I think it's the end of June. We're closing on this in May, late April, early May. So we just don't really see that being an immediate risk here, albeit it's a long-term, unpredictable. We don't know. We feel like that's a little bit of an unknown. And that's another reason why we feel very confident with our underwriting and the capital expenditures that we've brought into the table. If there was anything like that in place, we've got like easily an extra $100,000, if not more, in capital expenditures that we believe we've got wiggle room on. So we think we've got lots of padding there. We also have a strict, no pay, no stay rule that we have in our operations. And so we jump on it straight away. If the tenant rent's due on the 1st, for the most part, it's due on the 1st, it's late on the 2nd. If they don't pay by the 5th, then usually on the 6th, we can incur a fee, and then notices will go out on the 6th or 7th. So, and then we're pursuing to the fullest degree. So we stay on top of them. We don't let things backlog like a lot of other operators do. But it is something that's out of our control, and it is something to definitely take into consideration. And again, this is going to affect the entire rental sector, not just mobile home parks. But what we've seen so far, interestingly, as some of you may know, with the lockdowns that happened, with the government assistance that's been provided through stimulation and other incentives and unemployment and whatnot, we've actually seen the financial capabilities of our mobile home park tenants massively increase through all of these downturns here. So we've actually been solid. We're looking really good on collections, and our tenants have been generally more cashed up, so to speak, to be able to take care of their monthly housing payments. So that's actually been something that's worked in our favor. Kind of ironic there, the way that works, but that's how we've seen it in the affordable housing space. Another of the top 4 execution risks that we see is interest rates increasing. Now, we have calculated for a 4.5% interest rate at the refi, whereas we'd likely refi in the high threes or low fours. But we also think that we've got plenty of wiggle room in our LTV. Again, we could have that much higher. So if, God forbid, there was interest rates that increased higher than our projected 4.5% for this particular asset at refi, which again, we're projecting to actually do at about year 2 instead of year 3 in our projections, then we believe that we still have tons of wiggle room in our loan terms and our cap rate for our underwriting and our LTV, and even some wiggle room there in our financing interest rate as well. So we believe that we've mitigated those interest rate risks. But nonetheless, that's definitely something that we need to take into consideration. And again, something that's out of our control. So we can control all of the things through our due diligence and our underwriting assumptions, but these are the things that just are out of our control. And that's why we believe that these are the top execution risks. Cap rates increasing is the last one. We've covered that tons of times throughout this webinar here. And we're currently seeing cap rates in the 5 to 7 range. We feel confident that we could sell in the 6 to 7 range, but nonetheless, we've underwritten with our exit cap or the cap rate for the refinance and at our exit at year 7 being an 8% cap rate. Unless something insanely happens between now and then, we believe that that's very, very conservative, and we feel very confident about that. So we feel like we've done well to mitigate that risk as well. But nonetheless, all of these things are risks that we need to take into consideration. We need to feel comfortable with them, and you guys need to feel comfortable with them too. And I mean, obviously, these indicators are going to be things that are going to affect most property owners, most rental properties, things that are out of control of our day-to-day operations. The next question is, what sort of debt will you get upon refinance? We have this in our investment summary here, but to go over it again, 64% LTV, which the reason it's 64% is just to return enough capital to our investors at refi to return their original capital invested. We believe we've got a lot of wiggle room there. And then we've underwritten with a 4.5% interest rate. That's currently in the 4% range if we were to do it today, and high threes, low fours if we were to do that financing today. Also, we've underwritten with 25-year amortization and 8% cap rate, which is cap rates currently in the 5 to 7 range. Our next question is, and just a couple more questions here, guys, and we'll wrap this thing up. What is the rent credit program? Well, rent credit programs and rent to own programs work out to be pretty much the same, a little bit different, but the long and the short with those is it's not all tenants that come into the community is going to be able to pay full price for their home. Again, we are in affordable housing, so some of these people need to either get financing on these homes. Obviously, we mentioned 21st Mortgage can take care of that for our new home purchases. They can for our used home purchases as well. But if for any reason our tenants didn't qualify for 21st Mortgage financing programs, then we, the park, can offer them home ownership programs of rent to own programs or rent credit programs. And the way they work is that effectively each month tenant's going to be paying home rent and lot rent. Okay. Now the lot rent goes to the park. The home rent goes to the park as well. And then each time they're paying home rent, they're effectively chipping away at the value of the mobile home because they're putting more into it. Okay, and once they reach a point where the amounts that they've been paying towards home rent is equal to the amounts that we agreed upon for the sales price of that home when they originally signed the lease and the home ownership program, then at that point, we can award that home to the tenant and then sign over title to them. And then it becomes a tenant-owned home. We typically do this in about 3 to 5 years, and that's based off the monthly payment and the used home price that we have. So usually we see that the turnover, but going from a park-owned home to a tenant-owned home in 3 to 5 years. And that segues me into the next question that came in here, which is, do you plan on keeping park-owned homes? We get asked this question all the time. Most of you will know what our philosophy is on park-owned homes. Look, at the end of the day, we don't want any park-owned homes, for the simple fact that when you have a park-owned home, for the most part, the park is responsible for the repairs and maintenance. Therefore, you could guess, if you're comparing a tenant-owned home to a park-owned home, tenant-owned home is going to have a higher pride of ownership. And so we like to see higher pride of ownership. Now, going back to the rent credit program or the rent to own program, the further that they get through the program, the more skin they have in the game. The closer they're getting to home ownership, the more real it is that, when I become the homeowner, I'm going to be responsible for repairs. So it incentivizes them to actually take care of the home better and to have a higher pride of ownership, because they're working towards ownership and they don't want to get stuck with the repair and maintenance bill. So that's a good thing. But what we do is we would buy a park that has up to 100% park-owned homes. If that was the case, we're certainly not scared of taking them on. They are profitable. We make money off our park-owned homes. It does work. It's just for all of the management that we put into it, it's not really worth the return on investment. So we like to put our tenants on a home ownership program, rent-to-own program, rent credit program, where they're working towards home ownership in 3 to 5 years. And that way we get all the park-owned homes off the books. We relieve ourselves of that inventory and that liability. And there's a much higher pride of ownership. And also there is some mobile home park owner operators that much prefer to purchase a park with a lower park-owned home count. So that works out favorable for us when we get to the end of our cycle, where we actually have significantly less amount of park-owned homes, if any at all. And you'll see in our underwriting that we've actually projected to, keep some of our park-owned homes through the investment cycle. But in actually, we did that to remain conservative. But in actual fact, we're looking to offload all of those as soon as we can. And even though they may be on a 3 to 5 year home ownership program, when it comes tax time, when it comes time when we know that some of our tenants are getting payouts for things, we offer them opportunities to buy out that home at a discount. It works out for us. We get the cash now. We get to take that inventory off our books and reduce our liability there. And so that's pretty much our philosophy and how we work on park-owned homes. And then the last question here, and we'll get to wrap it up for you guys. And again, I really appreciate you guys devoting your time to explore the possibility of investing in this investment here. The last question is, what is the cost of the new homes being brought in to rent out at $450 a month? So like we said earlier, we've got one of our homes in our community is actually renting at $450 a month. We know we can sustain that cost for new homes coming in, but what's the cost to bring in those new homes? Well, we touched on that with the cash program. The cash program is going to cost us about $6,000 per home of an upfront cost for us to hook up the utilities, the skirting, get it signed off by the building inspector, and to hook up the stairs and patio and balcony and all that kind of stuff. And then once we find a qualified tenant, that $6,000 gets reimbursed to us. So it's essentially a temporary $6,000 cost per home. And then to add a little bit more color there, I know the question was only about new homes, but for our used homes, our cost is historically we've been able to bring in used homes and for $15,000. And then we can end up selling them in the $18,000 plus range. But we can also, we've actually underwritten for us to do that for $20,000. So we gave us an extra $5,000 wiggle room for any things there that could pop up. So we believe that we've been extra conservative there. And again, we calculated for $200,000 for all of these costs bringing in new homes. That would be $20,000 times 10 vacant lots using the maximum of used homes. We're not planning on actually doing that. We're planning on using 7 or more of the cash program homes. So we actually expect that capital expenditure item to be significant less, but we added it in there anyway to be conservative. So really appreciate your time. We hope that you found value in this webinar and also in our frequently asked questions and questions that have come in from you, from investors. If you guys have any more questions, please reach out, email me, Bryce at PropertyWorkz USA. Works is spelt with a Z or a Z at the end there. So that's Bryce at PropertyWorksUSA.com. Shoot me an email. Remember, this investment is open to accredited investors only. If you're not an accredited investor, that is okay. You can still reach out to us anyway and explore some other investments that we have. There is a little bit of a qualification process, but yeah, I think you will enjoy the process. And also, we are anticipating having a few more investments open to non-accredited investments in the next month or so. We've got a couple coming up there. So definitely a lot of activity going on for us. We're in a high acquisition mode. So if any of you are not accredited and you're looking to explore the possibility of investing with us on future investments, make sure to reach out to us now, because we are a relationship-based investment firm. You have to build a relationship with us before we can present these offerings to you. So make sure to reach out sooner than later. All you have to do is email me and we will take it from there. And for those of you who are interested in investing in this that haven't given us a soft commitment yet, now would be the time to reach out and let us know, hey, thanks, we saw the webinar. We're interested. We want to invest in the deal. We're anticipating investing X amount. Obviously, it has to be $50,000 or more. And please also let us know how you would plan to invest, whether it's going to be through cash, through a retirement account, a trust, a LLC, or anything like that. That just helps us logistically plan and set things up on our end, especially with our attorneys and the legal side of things. And then that would be a soft commitment. It's not legally binding. You're not being held to having to invest at that point because there's still you would still want to review the private placement memorandum, the subscription agreements, the LLC operating agreement, and all our legal documents there as well, which we are anticipating will be available in about a week to 10 days from now. So, so those of you who give a soft commitment, again, it's not legally binding, but we do ask that you only give a soft commitment if you really are intending to invest. We certainly don't want someone's seat to be taken by a non-serious investor. This is for serious investors that really feel comfortable with this investment and want to move forward with it. So yeah, again, reach out, Bryce at PropertyWorksUSA.com. That's the best way to reach us and get the wheels spinning on this one. And we, as far as timelines go, we're anticipating the legal documents to be ready in about 7 to 10 days from now. And we are projecting that that investor capital would need to be received mid to late April. I think that the deadline is in one of the days in the last week of April, and then we are projected to close on May 1st, so or at the beginning of May. So I know that we have some tight timelines on this one. Usually we don't have timelines that are this tight. Just it happens to be the structure because we actually are doing a cash purchase. We don't have the financing period or the financing contingency in this in our purchase and sales agreement. So the timeline's pretty quick on this one, hence the pre-recorded video that you're watching right now. So again, thank you very much for your time. If you've got any questions, if you're not quite sure about, wanting to move forward on it, you need some more clarity, again, shoot me an email, reach out, let me know. We'll answer any questions you got. We can answer by email. We'll jump on a video call, whatever you guys need. So it's been a pleasure to be able to present this opportunity to you guys today. Thank you very much for joining us, and I look forward to speaking to you all soon. Thank you very much.